Good morning, all of you. Am I audible, ma'am? Good morning, ma'am. Ma'am, you are muted. Good morning, sir.
Good morning, sir. You are audible.
Okay, thank you, sir. So,
Good morning, Gaurav sir. How are you?
Good
fine,
morning,
sir.
sir.
Good morning,
Namaskar.
sir. Namaste, sir. So, good morning, all of you. I, Dr. Gaurav Kumar, on behalf of the organizing committee of this event and Galgotia University family, I would like to welcome you all in the All India Council of Technical Education, Ministry of Education, Government of India sponsored session on angel investment, VC funding opportunity for early stage entrepreneurs. This event is jointly organized by IISc Galgotia University under Mentor Mentee scheme with Gautam Buddha University, Greater Noida, Sobhit University, Meerut, Raghunath Girls Postgraduate College, Meerut, Tikaram Kanya Mahavidyalaya, Aligarh, and SSB PG College, Hapur. So before proceeding for this workshop, I will briefly discuss about the innovation and entrepreneurship culture at Galgotia University. Our university has established IIC under Ministry of Education Innovation Cell in 1819 academic year, and since 2020 to till date, IIC of this university received highest star rating, that is 4-star, by Ministry of Education Innovation Cell for promoting the innovation and startup at campus by organizing IIC calendar activity, MIC driven activity, IIC celebration activities, and self-driven activities. Till date, IIC GU organized more than 250 events on entrepreneurship, innovation, IPR in collaboration with the various departments and schools of the university. The IIC Galgotia University is proud to be included as a one amongst 17 governing members of IIC Consortium, Uttar Pradesh, as well as we got selected as a mentor institute with funding support by Ministry of Education Innovation Cell, Government of India in 2023. The university ranked among top 50 university in India in the NIRF Innovation Ranking 2023 declared by the Ministry of Education. Apart from the IIC, the university also actively participated in Kapila scheme and adopted National Innovation and Startup Policy. We have developed the Yukti portal for the submission of idea, innovation, and startup from the student and faculty member. Till date, we have received 2000 plus ideas and innovation from the Yukti portal. We have also established an dedicated IPR cell that supporting the free IPR filing by the student and faculty members. The university also ranked among top 3 patent filer in Pan India. The university has established a student-driven e-cell and innovation cell that consists more than 500 students member. The university also has incubation cell, Galgotia Incubation Center for Research, Innovation, Startup and Entrepreneurship as an independent Section 8 company that is registered on the Start in India and Start in UP portal. Currently, we have 100 plus startups that are under pre-incubation and incubation stage. We have also a strong network of 150 alumni entrepreneurs who are providing mentoring and linkage support to the incubated startups. More than 30 plus faculty member has completed the advanced level of innovation ambassador training offered by the Ministry of Education, AICT, and providing support and mentoring to the student to transform their idea into the startup. We have hosted several flagship events like Smart India Hackathon, Toycathon. We have also participated in previously Drug Discovery Hackathon and ID Bootcamp we have also hosted. So with this word, I am wishing you a great learning ahead. Thank you. Now I would like to invite our Director IQAC and Vice President of Institute Innovation Council, Galgotia University, Professor Meenakshi Sharma ma'am, to kindly introduce and invite our keynote speaker. Over to you.
Thank you so much, Gaurav. Am I audible?
Yes, ma'am. Yes, ma'am.
Okay, so welcome. First of all, I delighted to announce that Dr. V.K. Arora sir has joined in as a mentoring to our student and our participants. So Dr. Arora that brings a wealth of experience and expertise in their area, and we are thrilled to have he is on board. So I welcome to you, sir, and I really thankful to you to in a short notice you had to join our session. Thank you so much and welcome to you.
Okay, thank you so much for your kind word. Now let me introduce our speaker again. Dr. Arora sir is a technocrat, bachelor in engineering and master in business with PhD in entrepreneurship. He is actively serving as Indian entrepreneurial startup ecosystem from last 20 years. He has conducted thousands of the workshop, mentorship session, programs, and courses in the domain of innovation, entrepreneurship, startup incubation, and venture development. He is associated with the several successful entrepreneur, startups, incubation center, investor, institutes, university, and government department as an hand-holding and advisory support. He is impaneled as a resource person, expert member, and advisor with the numerous committees and consortium. His job and work profile is dedicated toward women entrepreneurship and alignment. Presently, he is associated with the leading incubation center supported by the various department and Ministry of Central and State Government and Corporate World as a Chief Executive Officer from last 7 years. So we are very grateful to have you as a mentor and a keynote speaker, sir. Over to you, sir. Thank you.
Gaurav, sir. Namaskar. Am I audible, Gaurav, sir?
Yes, sir. Yes, sir.
I'm thankful to Dr. Meenakshi Sharma ma'am for having invited me for this online webinar. Gaurav, sir, thanks a lot to you also. Means long back, means 2 months back, you have given me this session well in advance. So I'm thankful to you. All the mentee institutes and the participants from Galgotia Institute and other institutes. Gaurav, sir, are you able to see my screen?
Yes, sir. Yes, sir.
Am I audible?
Yes, sir. Previously, your PPT was visible.
So, shall I start?
Yes, sir. Please. Sure.
So, in today in the topic, we will be talking about angel investment and VC funding opportunities for early stage entrepreneurs. I am Dr. V.K. Arora. I am taking care of one of the incubation center of Delhi. So before we go ahead about the talking about the investment opportunities and to understand the concepts of the investment, first of all, I will take 2 minutes to explain you that how this flow actually starts. Whenever you want to develop a startup ecosystem in any country or in any region, it basically starts from promoters or promoters. So when you actually go and you try to capture a good kind of people who are ready to take up some assignments in the startup ecosystem, the first decisive factor is to select good kind of promoters. I always emphasize whenever I'm going to evaluate business ideas or maybe some startups, I always emphasize on this first parameter, that is about the promoter. Once you are confident about the promoter, yes, this person is good with all kind of IQ, EQ, SQ, and AQ, and is having a good clarity about the business idea and about the investment. Then after, the second thing, what is expected from the promoter is that is about the minimum viable product. This minimum viable product is very important, and whenever we try to understand it or try to see it from the point of view of the investors, we also give a good weightage to the minimum viable product. I tell you a fact that in my whole career in entrepreneurship, what I have seen, that out of the failure startups, or out of those startups which cash fail, 90% of the startups fail because their minimum viable product is not a minimum viable product. So whenever we talk about a minimum viable product, there is one term which is associated with this minimum viable product, and that is about the value proposition. A good minimum viable product is that product which is having a considerable and a good amount of value proposition associated with that product. Why I am saying this and why this slide is very important, because from the point of view of the investors also, investor try to understand after analysis of a promoter that what is the product, or what are the products, or what are the services. So those services should have enough kind of value proposition that they are satisfied that they are going to invest their fund into that product which is having a bright future. It is just like this, that you are going to invest in your child, in the career of your child who is a bright one. So like that, all the products in your portfolio, they are just like your children, and you try to analyze it from the point of view that it is going to give you an edge during in the coming future or not. After that, the third thing is about the company and the startup. This company and the startup structure is also very important from the point of view of the investors, because whenever investor is going to put any fund, it is not in the shape of a loan or not in the shape of a grant. It is always in the same shape of the investment. Investment means in lieu of the amount they are going to invest in your company, they are expecting some share or some equity from your company. So this point is also very important from their angle. Now the next thing is about the growth hacking. Everything is fine, product is good, company has been established, and now you are into the market. Your product is out into the market. Legally, you are trying to capture your market share. Now you need to enhance your marketing in such a way you are able to capture more and more market. That is, you are approaching from a smaller market to the bigger market, to the total addressable market kind of stage. So here what you require, the growth hacking. Growth hacking strategies are basically linked with the marketing. From the point of the marketing, how you are going to capture the market, how quickly you are going to capture the market. So such kind of growth hackers role also shows that what kind of business model you are going to follow. And after that, when you are successful in growth hacking and to deploy your growth hacking strategies, now you can say that your company is an investor ready startup. Your startup is ready for investment. So this point is ultimately very important. If you try to analyze it, if you try to see it from the point of the investors, so all the four stages are very important. Number one, who the promoter are. Number two, what is the product or what are the products? What is the structure of the company? How you are having a good kind of business plan, which is directly linked with the marketing strategy, and within the marketing strategy with the growth hacking kind of strategies. And then after we say that the startup is having good prospects and is going to be, or there are good chances that this will become a successful startup. So this is very important for you to understand for your startup at any stage, maybe at the idea stage, maybe at the early stage, you will have to understand that these are the steps from the point of view of the investors. They are always keen to understand each and everything about these 6 parameters. Interestingly, the main point is this, that before your organization or your startup is ready for the investment, prior to that you will have to take care about all the expenses by your own. That is why the heading is the self to external sources of funding. So it is like this, that first of all the fund is coming from the promoters, then after slowly and slowly you are having growth prospects. Now the second part is this, that there are different stages of investment. Maybe it is a fact that at idea stage or at early stage startups, there are very little chances that you will be getting some investment from any investor, from any qualified investor. It is a fact. But then too, it is not restricted that at idea stage you cannot get fund. Similarly, this is also not restricted that at early stage startups you will not be able to fetch some investors. It is not conditioned. If you are ready and investors are ready, there is no doubt about it that you can get investment at any stage. This is a fact that most of the time, in most of the startup cases, you will get investment either at the stage of mid-stage startup or at the stage of when you are ready for investors for the stage of series A, B, or C kind of stages. Most important point is this: say it happens that you are able to fetch interest of any investor in your startup at idea stage. Means company has been incorporated, but then too you are saying that it is more close to the idea stage. Either the product has not been launched into the market, or if the product has been launched into the market, not a big kind of people, means they are known about your product. Even you are having a lighthouse kind of customers, first group of customers, and you are moving very slowly. At that time, you will have to understand that most of the investors are only interested about the team. Who are the team? So promoters, that is why promoter as a leader of that team, it is having a lot of values. We want to understand who are the promoters, what are their background, what is their qualification, do they have any experience, prior experience of doing business or not, and most important, are they clear about their business or startup or not, are they clear about the investment they are looking for or not, if they will be getting some investment, are they clear about the expenditure or not, and nevertheless the articulation, how the promoter and the team they are able to articulate and they able to explain their business ideas. Later on, when this stage has been crossed, you are at the early stage startups, and till now you are not able to get any kind of investment. Then along with the team, that is why you can see this mark of plus. Plus means on addition to the team. The next point is also added into that, and that is related with the mode. Mode is directly related with the value proposition. Again, I am talking about the minimum value product, but mode has a little difference. Moat means how you are different than your competitor and how long you will be able to differentiate yourself in comparison of your competitor. Means what investors are looking. Investors are looking, this is a fact that investors are looking about the first movers advantage. And along with that, first mover advantage is fine. And along with that, they are also interested to understand, to know that how long you will be able to make first movers advantage. And that is the key. The key is related with the moat. So moat is the differentiation, the underlying magic, that how long you will be able to differentiate your product. Whenever any investor is going to put any amount, say 1 million rupees, then he is able to should be able to understand that out of that 10 lakh of rupees, out of that 1 million of rupees, if the product is launched into the market during the time when there are no competitors, or there are very limited competitors, do that time at that time also, whether they will be able to get a good return or not. And the third stage comes, that is about the potential matrices. There are a number of matrices. Matrices means the number, the glorified numbers, interested numbers that on which they are interested to. So along with the team, along with the mode, the third thing comes about the market size, which is related with the matrices. Generally, matrices are related with those components which are directly linked with the marketing strategy or pricing strategy. And that is why the third component, which is added from the point of view of the investors, that is about the market size, that how big the market size is. You know about the TAM, you know about the SAM, you know about the SOM, and then after related with the market segregation, then targeting and taking the position. So they want to have a clear idea that how long the market is. If the baby is launched into the market, how quickly it will penetrate the market. And the last one about the business plan. Although this term is very old, means from last many years we are using about the business plan, but in the business plan also the main things are about the harvest strategy, the pivot points, that if the sub product is not successful into the market, how quickly you will pivot from one to another, and what will be the exit strategies, because all of the investors they are having their fund life cycle. Fund life cycle is that period, that for that period they are going to invest in your company. Generally, in India, the fund life cycle is maximum with the angel investors, that is 7 years, and with the VC funds, it is in between 3 to 4 years, which means that after this cycle, after 7 years, all the angel investors, they want to get return of their money. I should either I should either say that they want the complete money back to their account, and the terminal point, that the termination point of their funding, that should not go beyond 7 years. So that is why business plan is important for them. Whenever any investor is going to invest in your company, if your business plan is not ready, they will always ask you to prepare a good business plan. So that is why I explained these all the four things. Now I will not take much time in this slide because this slide we have already covered. But just as a pan of pan of a scale where four pans are there in the scale from the investors drivers, please remember that these 4 points and only these 4 points and only these 4 points are important from the investor's point of view. So whenever you are going to present any presentation, you are going to give your business discussion you are going to have with your investors, or you are going to pitch before your investors, please understand that time is very limited given to you, maybe for 5 minutes, maybe 10 minutes, maybe 15 minutes, at least at the early discussion. So you will have to focus about these four things because all the investors, any kind of investors, they are interested to understand about the team, about the mode, about the market size, and about the business plan. And in the previous slide, I have already explained you that what exactly should come into these 4 points. If your business is at idea stage, talk about the team only. If your business is at early stage, along with the team, you will have to focus on mode also. If you are at the mid stage, that along with the team and the mode, you will have to talk about the market size. You will have to show them that how big the market is, what are the entry barriers you can create for your competitors, and how quickly you can move. And in the last, that is the series A, series B, and series C kind of investment, we talk about the business plan, and that is the full stop. When you talk about series B kind of investment, then in the business plan, it should also already should come that what we have done with the funding which you received in the series A. Now I am coming for the presentation. When you are going to present your idea or your startup before the investors, there are four different ways. Number one is the pitch video. Generally, this pitch video is in the shape of the video, which is from 1 minute to 4 minutes. Investors are asking you to prepare your pitch video and just show to them. It is the better way, and investors feel like this, that in the first interaction at least, the complete pitch deck is not required, and they are satisfied with this, that you prepare a 1 minute or 2 minute pitch video and you just show it to them. There are a number of freelancers who are preparing pitch video. Generally, we suggest our startups, those who are looking for the investment, to prepare two pitch deck, one for 1 minute and another one for 4 minutes. But what will be the content? The content of any pitch video will only be these four. You will have to talk about only these four. Now, that is the part number one. Many times you will find that people are asking you to prepare a pitch deck, or they will give you a time they will be calling you in their office, and they will be asking you to present about the pitch deck. So there is a format of pitch deck which we generally share with the students. If you want, we can also share that kind of format of the pitch deck with you. And generally, in that format of pitch deck only, you are expected to present before the investors. The third point is very important, which is generally seen, and especially the investors who are outside India, they are providing you their own format, and one-page format, or maybe maximum two-page format. And there are some entries they are interested to. Now it happens in such a way that it is expected that all these four things you are going to cover in your video presentation or maybe in your pitch deck. This is expected. But this happens in some points where investors are interested to understand about some other thing. About some other thing may not be related with the team, mode, stream size, and the business plan. This generally happens when there are investors who are going to invest in some specific project. Maybe I am interested to only cyber security, and maybe I am having some that kind of things which are required to know from your end, which is dated only from that. So maybe I will be putting those things in my investors format. And last one is the business plan. Business plan is a detailed business plan. Generally, at the beginning stage or at the first meeting or second meeting, investors are not asking you to prepare and to submit a business plan. Generally, it is asked only after the signing of the term sheet. Otherwise, business plans are not asked. And we as a consultant, we as an advisor also suggest you never to share business plan unless your complete term sheet has been not been signed, or your complete share purchase agreement or shareholders holdings agreement that has not been signed. So these are the four ways you can present your thing. Now, this is very small thing. You all must be knowing about it. There are a number of terms which are very famous, that your company is a minicorn, or it is a sunicorn, or it is a unicorn, or decacorn, or hectacorn. In India today, we are having approximately 113 unicorns. We are having total 3 decacorns and number of minicorns. Now, the point is this, that as you all must be knowing, all these kind of cons are related with the valuation of your startup. Please remember what I'm saying. I'm talking about the valuation of your startup, that is the worth of your startup. It is not related with the revenue what you are having. It is not related with the profit what you are having. If you say that my startup is having a valuation of 1 billion, it means that it has come to the category of unicorn. So when we say that we are having 113 unicorns in India, it doesn't mean that all of these unicorns are in profit. The point is this, that if they are going to sell their startup into the market, they are expecting 1 million of the 1 million of USD. And from when and from how they have received this particular figure, that is about the post money, pre money kind of valuation, which we are going to see later on. Now, this is a small thing just to understand for you, that if $1 is equal to 83 rupees, then what do we mean with the valuation? And if any investor is going to invest any amount in your company, how much he is going to or she is going to invest in your company, against what percentage of equity. So here I have given example of one minicorn. Minicorn are those startups where the valuation is over 1 billion USD. 1 million USD means how many? 1 million is equal to 10 lakhs. So 10 lakhs USD. Today, the value of USD is 83 rupees 50 paise, but say it is 83 rupees. It means the 100% of the company valuation is equal to 1 lakh, 10 lakh of USD. That means 8.3 crores of Indian rupees. If you convert it to Indian rupees, having a base parameter of 83 rupees per dollar per USD. And accordingly, if you consider it for 1% equity, 5% equity, 10% equity, and your startup is having a valuation of 1 million, it means that as an investor, if I am interested to invest in your company, and I am going to invest 10,000 USD in your company, that means 8.3 lakhs of rupees in your company. According to the thumb rule, I will be getting 1% of the equity. I hope this is clear to you. Likewise, if I am interested to buy 5% equity in your startup, then I am expected to invest 50,000 USD in your startup. That is 41 lakhs 50,000 rupees in your startup. So this is a rough calculation. You can always keep it in the backside of your mind. Now, when you are going to talk about the startup, there are 3 kinds of stages. At the time of investment, just before getting an investment, the valuation is known as pre-money. Just after getting the investment, you are supposed to enter the field of post money. That means post money valuation. And after that, whenever you will be getting further rounds, at that time also further rounds, say the next round is coming, then in the next round also the same thing happens, that whenever you are going to get the next round funding, just prior to that we say it as a pre-money, and just after that what we say it is a post money. So we are having, if you are a startup, since the topic is about the early stage startups, and you want to understand, sir, what is the valuation of my company, and my company is at the pre-money. Till now, we have not received funding, or we have not received investment from any of the investors. Then how should I understand that what is the valuation of our company? Our company is a minicorn, or it is having a valuation of 50,000 USD or 10,000 USD. How will we reach to one figure? So reaching to a figure is directly proportional to your own understanding with number of KPIs, with number of factors. Those factors are interested for valuer who is going to assign some figure to your startup and telling you that this is the uh, valuation of the startup. I have shown you only 21 parameters, but it is not limited to 21. But this I can assure you that it is also not having any beyond number of things except these 21. From my career, from my experience in the startup ecosystem, I have written these 21 points. Whenever I talk to investor on behalf of investor, I am going to bargain with the entrepreneur. Then I have seen that investors are interested only to understand these 21 points. I am not saying all 21 points, but yes, their mind, their consideration will be limited only to these 21 points. They may be interested to understand about the promoter's background. They may be interested to understand that how many patents you have filed and those patents are ready for commercialization or not. Or you are having some patent with you, it is having a scope to transfer the technology, or maybe reverse some license in, if it is possible, you are able to take some technology from some developed countries, from other companies also, and they have committed that their technology transfer to India will be limited to your company only for next 10 years. Such kind of, license in or license out kind of agreement, maybe customer acquisition cost, customer retention cost, maybe how quickly you will be able to increase the market share, maybe about the burn rate, what is the burn rate, how good the burn rate is, and what is the history of previous investors. Means you can take any of these points. But the most important part is this, that through whatever way you go for the valuation, pre-money valuation, means your startup is a fresh one and first time you are going to pitch to any of the investor, it is not a real valuation. It is not a real valuation. The most important point is this, that whatever way you choose, whenever you are going to bargain or you are going to present before the investors, investors may or may not accept it. They will simply reject it. Because in our country or in many of the countries, there is not a structured value to evaluate the valuation of a startup. So whatever way you do, they may or may not accept it. Although these are the 6 methods which are very famous by their name to understand about the pre-valuation. These 6 methods exist. There are total 11, 12 methods which exist, but these 6 are well known in the world startup ecosystem. You can go with the Barkas method, you can go with the scorecard method. VC method is also there. First Chicago method is there. And then after we are having risk factor summation, that is RFS method, and the rule of thumb method is also there. And we do it in a proper way. If I am a valuer and your startup is coming to me, so for the valuation, I will prepare a valuation report for your startup. I will give a figure that your valuation, your company valuation is 22,000 USD. This is the valuation on 5th of June 2024, dependent upon the data and the information the startup has provided to me. And after that, my report will start. In the beginning of my report, I will be mentioning that this report is based upon the scorecard method along with a risk factor summation method. I will be writing about it. Then after my report will start, I will also stamp the report. I will also sign as a registered valuer. Everything I will be doing it. But in the real world, it is not having any value else than a figure which is assigned to you and a paper which is signed. So what is the real way to understand the valuation of any startup? The real way of valuation you will get only after getting a post-money valuation. So this is how we do. So as I have already explained it to you that there is some valuation of your startup before you have received any investment. Then after money has been invested, and once the money has been invested, the post-money valuation becomes addition of pre-money valuation plus money invested. So post-money valuation is equal to pre-money valuation plus money invested. But to calculate pre-money valuation, the method is reversed. Method is reversed. How it is stated? The first you will have to calculate about the post-money valuation. Then only you can calculate about the pre-money valuation. that yes, this company was having this much pre-money valuation. And then after, it is always better to relate with any of these 6 methods or the report which the valuer has given it to you. It is a fact that if the valuer are qualified, definitely this figure will match with the actual method. But here it happens like this. Calculation is very simple. Calculation is like this, that you have asked for the investment and I as an investor is ready to invest in your company. I am going to buy 20% equity in your company. It was a first investment and I am going to invest 20% equity of your company and going to invest how much fund? USD 5 million. 5 million means 50 lakhs. 50 lakhs USD I am going to invest in your company against 20% equity. And then if you will try to understand from the reverse point of view, reversal of it, if 20% is equal to 5 million, then what is 100%? Very simple calculation. Again, I am repeating, 20% equity is equal to 5 million. That means 100 is equal to 25 million. I am simply multiplying it with 5. That means 25 million is the post-money valuation of your startup. And since I have invested 5 million from the same formula which I have told you in the beginning of this slide, that post-money valuation is equal to pre-money valuation plus money invested. Then simply from 25 million, you are just subtracting 5 million, which was invested by the investor, and you are reaching to a figure that is 20 million. So after investment, after getting investment, that too not from your family, not to your family, not from your someone who is your godfather, from any qualified investor, maybe angel investor, maybe VC funding, then only you can say, yes, this was my pre-money valuation and that is now my post-money valuation. Now there are two types of funding which you can get from the self funding sources to the external. I am directly interested to understand about the investment. These are the ways of getting your self-funding sources, and these are from the ways of your external funding. So what I have explained you, whatever I have explained you, that was only and only related from the investment point of view. And it is a fact that investment comes under the external funding for startups. Here, the important part is this, that you are supposed to dilute your equity. And if you will dilute your equity, to whom you are going to assign that equity? Your investors. And what you are expecting in return? The fund which is equivalent to the equity you are going to sell, right? So it happens like this. So it is not a grant, it is not a bank loan, it is just an investment. Now when you talk about the investors, there are many ways by which you can get investment from the business incubation centers. Also incubation centers are investing. Individual investors are also there, institutional investors are also there, then share market is also there. If the time will allow, I would like to talk to you regarding share market also, because these things I am 100% sure that in the coming time, share market investment is also going to be a popular instrument as far as startups are concerned. Now, when you understand this, that you are going to get some investment and you are ready to sell your equity of your startup to the investors, and you are expecting some amount, the basic concept is about the angel investors and about the VC funding. One is the angel investment, second one is about the VC funding. And this is the topic of today's session. Here, the topic is like this, that at the early stage, you are expecting investment from your angel investors and from your VC funding, venture capitalist. And that is the topic. Again, I would like to show you about the topic because you should be very clear that what we are going to talk about. The topic is about the angel investment and VC funding opportunities for early stage entrepreneur. Now, what do you say? Who are the early stage entrepreneurs? At the early stage entrepreneur, I am again emphasizing that at this point, you are at the verge to understand three important parameters. Number one, who are the team members? What is the profile of the team members? Number two, what is the value proposition? What is the moat, how long the moat is going to work? That is product market fit. And last one, third one is about the business market size, that how big the market is. So at the point when your startup is at early stage. That means it is not at the mid stage. It is not at the stage which when you are already getting or generating a lot of revenue. So at that time, we have to focus only on these 3 points. That team is point number 1, mode that is point number 2, and market size that is point number 3. Now, from that point of view, you will have to understand that this is the complete scenario. Angel investment and VC funding when you are going to approach to them. So before we go ahead, a basic concept should be clear to you that how angel investors comes under the individual investors and VC funding that comes under the institutional investors. See, although again I will be repeating it, but for now, angel investors are individual investors, which means Dr. V.K. Arora is an angel investor, fine. Your Professor Gaurav is an angel investor, it is fine. Your father, your mother is an angel investor, it is fine. You yourself could be angel investor, it is 100% fine. Just like you are going to share, you're going to invest in the share market. Here also in the startup ecosystem also, we as an individual investor, we are going and we are investing in some of the startups. So we are known as what the angel investors. Angel means, I hope it is clear to you, what do we mean by the angel? Angel investors, right? And on the second hand, we are having a group of investors, that is consortium of investors. That group of investors are known as it comes under the heading of the private equity. It all comes under the private equity. Now the question is this, that private equity fund structure is structured or not. If it is structured and at the starting level, then what we say that it is a VC firm. It is a VC fund which you are receiving from any VC firm, known as what the venture capitalist, right? So if it is structured, but it is a fact that in India previously also such kind of private equity were available, institutional investments were available, but it was not structured. So we used to call it as a private equity. It is a private equity. It is happening like this, that I have not taken permission from SEBI under category 2, which is required in alternate investment fund in the case of the VC funding. No restriction has been taken. I am having some fund, and maybe I should not say at this forum, but maybe I was having some black money and I want to invest it somewhere. Previously it used to be, and I am having just giving you a cash of 10 lakh of rupees and just I am investing in your startup. So from long back, from last many years, 50 years, 60 years, I am seeing that such kind of private equity that was available. But the investor was not a single person. It used to happen like this, that I have taken 5 lakh rupees from Mr. Ajit, 10 lakh rupees I have taken from Meenakshi, 20 lakh rupees I have taken from Hima, and the total corpus which I am having, that is 1 crore of rupees. Now that 1 crore of rupees, I am just investing in 10 startups or 5 startups. But I have not gone through with all kind of formalities. So what kind of investment you will see? It is also a private equity kind of investment, but it is not structured. So if you will say, sir, what is the difference between private equity and the VC funding? Then the main difference is this, that venture capitalist fund, it is a part of private equity. Likewise, anchor investors or the cornerstone investors, both are the same, are a part of the private equity, but structured. VC funding is a part of a type of the private equity, but structured. Marquee institutional investors, MII, generally we get such kind of investors just before, issuing your IPO. And just before you go for the IPO, you take some advantage of MII, that is marquee institutional investors, with the help of your merchant banker, right? So that is also private equity, a type of private equity, but very well structured. Foreign portfolio investors, where the money is invested by number of the investors which are from different corners of the world, not from your country, from different corners of the world. They are coming and putting money in your startup, but very well structured. And governments allow it. We are having number of startups, not only the startups, number of companies also, where we have received FPI, that is foreign portfolio investors, from those companies which are investment companies, fund company outside India. Many of them are in Singapore and Dubai. So you will get that kind of funding also. But since the topic is limited, we only have to talk about the angel investors, and we are supposed to talk about the VC funding. For you, the difference is only this, that angel investors are individual investors like you, like me, like anybody. Whereas VC funding or VC fund or VC firms are those companies where it is structured. Number of people, investors are there to whom we say it as a limited partners, and number of people are there who take this decision that in which company to invest, how much to invest, how long to invest, how to plan the exit strategy, who will be the consultant on behalf of VC funding if required, who will be the person on the board of the startup company if required. So those who are taking decision, so known as what? General partners. So in the VC funding, VC fund, VC funding, you will get two kind of people. One are known as limited partners, those who are funding, those who are funding, those who are money, those who are having money, HNIs or ultra HNIs, those kind of people, those who have put their money. And general partners are those people who are known, who understand the ecosystem, and they understand that in which company they should invest and in which company they should not invest. I hope this is clear to you. Now, before we go ahead, please keep in your mind that worldwide, these four kind of investors exist. Just a minute. Worldwide, these four kind of investors exist. Either you talk about the angel investors or you talk about the VC firm. Their mind is set like this. And as an entrepreneur, whenever you are asking for funding or you are ready to sell your equity, you will have to understand their psychology, that in which category they come. So before you understand their psychology, you should be able to understand that he comes under which category. So these are the four categories. I have made these four categories, so it is not defined. But generally, it is a fact that whenever you will understand their psychology, automatically your bargaining power with those investors that will be increased, because you understand that what they are looking for. So if we try to categorize all kind of investors in the startup ecosystem, these are the four categories. Number one, massive user. Those startups, for those investors who are looking only for the massive users. Massive users means it is a FM fast moving goods product company, invest in that company. It is having a business like Facebook, massive user will be there, invest in that company. A good fintech company, maybe a number of credit card user will be using that platform, invest in that company. So what kind of investors are there? They are looking for the massive user. And whenever they are looking for a massive user, it kind of, companies where massive users are there, the product of the company, they are not very much interested to go for a high tech or deep tech kind of startup. Even the low technology is qualifying their criteria. But the point is this, that scalability should be fast. Penetration should be fast. Yes, massive users are there. Today we are having 10 users. We are sure that tomorrow we are going to have 100 users. We are sure that day after we are going to get 1,000 users. And the users will be increased. And definitely if it is the fact, then the customer acquisition cost should be low. So these are the very few important things. And whenever you will be into the practice, many of the things you will be able to understand. But the only point is this, that massive user, what they can think about. When there are massive users, immediately you cannot go for the product kind of innovation or design kind of innovation. Immediately you cannot go. But what kind of innovation you can do? You will have to understand that it comes under this category. And then after you are interested to talk only about the process innovation. Sir, we will be doing this. After this, reaching this process innovation, we will be doing this. There is one person, we will be planning to target him, and he will be working for our organization. Churn rate is also there. Churn rate is high. Maybe it is sometimes good for the startup. Then what are the actionable, matrices? Just show it, and they are interested to know, because you understand, you have already understood that kind of investor is going to come under this category. The second one is about the diffusion of the innovation. in the diffusion of the innovation, whenever any new technology comes, you understand that there are total 5 stages, from the techies to the late entry customers. So there are 5 different stages, and between every 2 stages there is one impede. There is one one barrier. There is one barrier, and at that time you are not sure that you will be moving from the previous stage to the next stage or not. So in the diffusion of innovation, Elon Musk, must have understood, you must be knowing about him. Many of the new technologies, they are coming day to day. Means they are not very much interested that how many users will be using it in the beginning. But from the complete, normal Gaussian chart, they can understand that how big the market is. If this technology is going to be successful in the business, that how much they will make, is how much money they will make. Right? And at the same time, they are also prepared for this, that the chances of successful is only up to 20%. That if you are going to invest in 5 such kind of startups which are working on some diffusion of innovation, some industry 4.0 kind of thing, then they are understanding that out of these 5, only one, that is 20%, is going to be successful. 4 will fail. That is what the power law is. Later on, if the time will be there, we will be talking about the power law, which is stated with the VC firm or with the private equity. But the diffusion of innovation is this, that in the beginning, maybe you will not find number of customers there. But as with the movement of the technology, as with the as you will improvise the technology, you will improvise your product, you will be finding that number of people, they are coming to buy that product. If today you talk about the electrical vehicle, even the market is very big, but then too, the biggest point we have not seen, it is going to be a big market. So those investors who are trying to invest in such kind of technology, they understand that after 10 years, what will be the situation. About the AI, we are actually trying to integrate AI in all kind of startups. Right, one of the startup of Oyo, that was Kritim. It is latest unicorn in the year 2024 only. So number of companies are now investing in that startup, or planning to invest in this startup, maybe interested to invest in this startup because of the diffusion of innovation. They understand that how long the market is going to be. The third one is the main kind of investors, which are only thinking that money is the primary thing. Main motive is money is the bottom line. ROI, return on investment, is the bottom line. They are not very much interested for the massive user. They are also not very much interested about the innovation or the technology or deep technology. They are only able to understand that after 3 years, will we be able to get next series of investment or not? I mean, I am going to invest 10 lakh rupees in your startup, and it is 100% sure that after 2 years, I want, or I will be looking for 1 crore of investment from some other investor, so that I will sell my equity to him and I will come out when the next round of funding is happening. And it is very strange to see that investors come and they say, sir, we want to invest only in those startups where after 2 years we are finding, or we are able to get 20x kind of return or 15x kind of return. And not only this, we should also be assured that at that time also we will be getting some investment or investors. It is not like this that at that time we will not get any investor. So it is the combination of all these, both of these kind of investment. And the fourth one, unfortunately, in India, we don't find such kind of investors. But in Europe or in the US also, you will find number of investors. Those who are investing in only those products which are dedicated to sustainable development goal, that is ECG, where we talk about ESG, where we talk about the environment, we talk about the society, and we talk about the governance. So those investors are also there. Majority of those kind of investors you will be finding in Europe. The reason is this, that they have earned a lot and now they want to give back to the society. They are Earthian. They love your planet Earth. And immediately they are not looking for a profit, but definitely in the back of their mind, this is a fact that they are also looking for a for some investors. But yes, they have reached to the self-actualization. Their children are settled, or maybe they are not having children. So their money is like this. We call them as a social investors, and that is again they are talking about the circular kind of economy and the impact economy. Such kind of words are there. So in my point of view, there are four different kind of investors. Either you talk about the angel investors or you talk about the VC funding. These are the four kind of investors which you will be getting in the market. Now, before we step to the angel investor, these are the some of the steps which you should understand very clearly. As in the beginning, I told you that as a startup, first step is to make your startup investor ready. If you say that, sir, I am having a startup which is investor ready, means I am having a good kind of growth hacking strategies. Business models are also deployed, and I'm expecting good return in coming time. And immediately I need some funding to reach to the cash cow stage or to penetrate the level, and then after to make a lot of money. My moat is very strong enough to get success into the market. The next step is about the valuation of the startup. I'm not saying to go for the very well structured kind of valuation of the startup. A basic idea that your startup is of 3 crores of rupees, 30 crores of rupees, 300 crores of rupees, some basic idea that even with a good mentor you can have a discussion and you can have a figure that this is the idea. Why this is required, that whenever you are going to bargain with the investors, you should be able to understand that if I am going to sell 20% equity in my startup, how much money we can expect, and vice versa. If 10 lakh of rupees is required in my startup, how much equity I should sell. So these two things should be clear to you. For that, the valuation, a basic idea of the valuation is important. Then after, make a pitch deck. In the pitch deck, please keep those 4 points ready. And then after, you should have a clarity of the investment. If you are going to the investors and you are saying, sir, 50 lakh rupees investment I am looking for, then the next step, he may be asking you two things. Number one, out of that 50 lakh rupees, where will you invest? It should be clear to you. So these are the two machines I am trying to import from. I will be importing from Germany. This is the money I just want to keep it for their maintenance or AMC. This is the money I require for the raw material. This is the money I will have to pay to my consultant who will help me in preparing the product or in launching the product or in the marketing of the product. So such kind of things should be clear to you. And if the complete 50 lakh rupees you want to take in 2-3 different tranches, so my first tranche of 20 lakh rupees I need immediately. The next round of 15 lakh rupees I will be requiring in the month of August, 15th of August. And last round of funding I will be requiring at the time of or in the month of December. So this is what the clarity of investment. Then after, you are going to interact with the committee members of the angel investor or maybe VC funding. They will be doing due diligence. You are also suggested to do the due diligence before you take funding from any of the investors. Then you are having a bargaining power. Then you close your term sheet, you sign the agreement, and accordingly you update your article of association. Association of article. Okay. So this is how these 10 steps you will have to follow. These are the major 10 steps. If you are having any questions, we can take up at the end of the session. Now, I hope that everything is clear to you about any kind of investors. Now, it will not take much for you to understand angel investors. As I have already explained to you, angel investors are the individual investors like me, like you. And we understand that we are having some funding, some money, and which we want to invest. Maybe I think that investing in share market, that is not safe. Maybe I think that if I invest in fixed deposits, maybe I'm not interested. For the price of gold, I am not sure that whether it will be increased or not. It will be good in investing in gold or not. Any other kind of security, I may not be interested. I think that purchasing and going for a property or for a piece of a land or maybe investing in real estate, that is also not going to give me a good return. How many options we have? We can also go and buy some foreign currencies. How many options we have? But out of that, we will have to prepare ourselves as a mentor that startup ecosystem is a one part. But on the other hand, we should also have very strong investors association with us. Number of people, they come to me and they say, sir, I want to invest 5 lakh rupees or 10 lakh rupees to 5 to 10 startups. So in the beginning stage, if they want to invest, maybe we call them as angel investors. So it happens like this only. So they are also having some expectations, and you are also having some expectations from AIs. Exit priorities are very important. In general, we also suggest angel investors, if they are going to invest their money in your startup, they should have some patience, and the patient period should be in between 5 to 7 years, maybe 8 years, sometimes maybe 10 years even. If the situation like COVID, it comes, number of startups, number of investors, they got their return or they are expecting their return only after 10 years, but not beyond 10 years. But definitely it is in practical world, it is in between 5 to 7 years. Then one should have a good bargaining power with the entrepreneurs. So this kind of Indian investors are there. These are the 8 points which are very important. If I am going to make different slides, so I can make 8 different slides for, one slide for each of these points. I have compiled it so that you will understand that in one umbrella, one platform, that who are angel investors and what are their insights. So if you ask you, sir, who are the angel investors? So I have a very good experience working with Maruti Automobiles. And from last 20 years, I was working in Maruti. Now I am retired. I have a good knowledge about the automobile industry. And since I am having a good knowledge about the automobile industry, and I was also having, interest in electrical vehicle. So I am interested to those startups. I am interested to invest in those startups which are producing or which are into the automobile or which are producing electrical vehicle. It is not like this, but you are having an expert command in one sector or one industry, and that is why you are interested to invest in that startup or those startups. So you are having an expert acumen knowledge in respected vertical. You are going to invest in respected vertical. Maybe if you are good in marketing and you were good in marketing, so Martech companies, which companies are Martech companies? I'm interested to invest only in those. I want to invest. It is not like this that it is just a time pass I am doing. In today's time, you'll find a number of angel investors who claim that they are angel investors. And if you will go and you will go do their due diligence, you will find that they have invested only one or two or three companies. And then do they write a good tagline after their name that we are angel investors. On the LinkedIn, maybe you will be finding such kind of, you are wasting time for them. So you will have to understand that one person is interested, they want to invest or they don't want to invest. That is also some psychology, understanding. Even with the one meeting or two meeting, you will be able to understand. Then please remember that if you are going to or planning to get investment from the angel investors, try to find angel investors, or angel investors are also trying to find the companies where they are going to invest locally. It's a person in Delhi, maybe you will be getting good options of getting investment from a person from Delhi if you are in Delhi. A person in Chennai, generally, what is my experience, that you will not find that they are going to invest in any company in Delhi unless you are not connected in some other way also. Right? Because why it is happening? Because angel investors are expert in their field. So they are not only giving you time. Sorry, they are not giving you only money. They are also expected to give you time and mentorship, as you can see in the smart capital. So they also want to see time to time, and maybe it is a good thing with the angel investors. Maybe it is a disadvantage with the angel investors, that you may find, or you may say, sir, again and again they are asking for some report. They are asking for our annual operating plan or maybe something like that. But that is why angel investors, they are known as angel investors, because they are coming and they are seeing you day-to-day life, that what you are doing with their money, with their time, with their mentorship. They are active. They are not like this, that they are invested like VC firm and they are waiting for 3 years or 2 years or 5 years. So they will be coming to you. They may come to your office. In India, we are not having any agency which is giving accreditation to the investors. There are some consortium of investors. We are having city-wise also in Mumbai, in Chennai, in Delhi also we are having. But nothing like this, that we are giving some accreditation to the investors. What I mean to say is this, that if I am an investor, if I am coming to your startup and I am going to invest in your fund, in your company, and one should be mature enough to understand that I am expecting some return, or my termination point will be only after 5 years. But after every 6 months, after every 1 year, I I am asking you for my money, or what is happening, you are not giving me return, or I cannot see anything, you are spending too much on your electronic gadgets. So like this, if so much interference will be there, which generally happens. Many times we have seen that entrepreneurs, they say that there are a lot of interference in case of the angel investors, which are not there in case of VC funding. But yes, then too we go for the angel investment. Why? Because getting fund from angel investor, that is very easy. The contract is easy to sign. It is not having number of pages. Such kind of verdicts are not there. But then too we go. There are number of angel investors who are investing only in women entrepreneurs, or maybe in some sector specific, industry specific. But these are the things, if you are looking for an investor, from angel investor, you will have to keep in your mind that this may happen in the ecosystem. This may happen. Right. So although the money is the prime thing, but number of times people think that they want to give back to your society. I know number of Indian investors who are helping only those startups which are working for the problems related with SDGs, Sustainable Development Goals, and they are investing their money. They are also helping in publication of their startups products, in participating in different exhibitions, not only in India, in abroad also. So such kind of ecosystem is this. So the point is this, that when you find an angel investor, you try to understand that that person is going to help you as a co-founder, as a co-promoter. There's no competition. There's nothing like this that they are asking you again and again their funded amount, and they are relaxed about their fund life cycle. That after what time they will be getting something in return. Now this is very important slide, and I made it after getting good experience with the interaction with the angel investors. Although I will not talk much about it, but what you will have to understand that every angel investor, if they are going to invest their product, what are their expectations? What they are expect that the value of your startup will increase 10 times to 30 times after 1 year. After 1 year. After 1 year, I am not saying after 5 years or 7 years. After 1 year, what are their expectations? That the valuation of the startup where they are going to invest, that should increase by 10 times or 30 times. That is 10x to 30x ROI. And it is not impossible. It happens. It happens. Today, if your startup is having a valuation of 1 lakh of rupees, in the beginning stage, in the early stage, your growth happens like this. It grows like, in a good shape. It takes as a shape like, curve kind of thing, where you will be finding that if at the beginning stage, at the idea stage, or at the early stage, if your valuation of your company is 1 lakh of rupees, it is very easy to make it 30 lakh of rupees after 1 year. Very easy. 1 lakh to 30 lakhs. How much growth? 30x. But after 5 years, at the case of the VC, when VCs are going to enter as investors to your company, at that time, this growth decreases. It is not like this that you will be always getting it 10 times, or 30 times, or 25 times. But their expectation is like this, that it should lie in between 10x to 30x. They are investing in 12 to 15 companies at a time, and they know that only 2 to 3 companies are going to perform. Rest all will fail. Rest all will fail. Out of 12 to 15 companies, only 2 to 3 companies are going to be successful. And they know, they were having expectations that they will be having a growth of up to 30 times. And only 2 to 3, say 3 companies only became successful. One company with a 30x, one company with a 20x, and the third one with a 10x. The rest, all the 9 companies, they failed, or maybe 12 companies that failed. But what they are getting ultimately, it is up to 30% only. Up to 30% only. Means if I was having a corpus of 1 crore rupees, then after 1 year, I am expecting 1 crore 30 lakh rupees. In broad sense. So this is what they are getting. Why? Because out of their complete portfolio of 12 to 15 companies, only 2 to 3 companies or maybe 4 companies that actually perform, and rest many companies that fail. And along with that, they should be also very clear that yes, what will be their exit plan, when the VCs will be coming. If they are having their own resources to generate VCs, which is generally happening, so they are arranging it. Sir, I have invested this much money. The company is performing good. Promoters are trustful. They are ethical. They will give you the right pictures. Their CFO, this person is CFO. These are the company secretariat. These are the legal people. I know them personally. So if you want, can also invest in that money. In the backside of my mind, as an angel investor, it is clear that I just want to go out. I just want to sell my equity to those people, those who are coming in the next round of funding, and I want to go out. Maybe later on, I think there's some IPO. Many of the times I've seen that IPOs are also there. So we are interested to do some merger and acquisition. Reverse mergers are there. So many things are there. So these are all the points. I hope I've explained you everything about the Indian investors. Now, when you talk about the VC firms, again, as I mentioned, that Indian investors are individual, personal, and venture capitalists, that is the firm. So these are the main things which you will have to keep in your mind. And there is also a different kind of mind strategies required when you are dealing with the angel investors and when you are dealing with the VC firms. As in the relaxed manner or very casual manner, you can talk with the angel investors. In the similar way, you cannot talk with the VC firm. Here you will have to talk with the selected words. That this much I will have to talk. It is not like this that they are calling you or you are going to work with them, thinking that ultimately they are also partner of the company, they are co-founders. We are treating it as a co-founder, not co-founder, but you are treating it as a co-founder because they are also having a stake in the company. It is not my baby. It is also considered to their money. Here it is very structured. You will have to understand that they will have going to fund in your company. They are going to invest in your company because of only and only one thing, that is return. And that too, generally in between 3 to 4 years, maybe up to 5 years, because SEBI has some set of rule for the LPs, those who are going to invest in AIF certification. So if this is the situation, so these are the different ways. Also, if you are having questions, we will be able to discuss you. But this is very important for the VC's point of view. Number one, if you are going to have a structured kind of VC firm, you will have to take some permission from the government, in which SEBI plays very important role. There is one category of AIF, category 1, which I will be discussing with you, that how you can have your own AIF, you can have your own fund, and then after you can invest in the startups. That comes under category 1. There is also category 3, which is for the hedge fund, and category 2, which comes under in between to 1 and 3rd categories. Generally, real estate kind of investors, that comes under the category 2 of AIF. But here we are only interested to consider the category 1 of the AIF. You should also understand from the point of view of the VC firm that they are also responsible to deal with their limited partners, and they understand that what their limited partners know, and they are expecting. It should be clear to you that at what time, how much return they are expecting. You should have very good and honest general partners. It should not be like this. It is not a government department or something like this that I am a general partner. I understand about the startup, but I am investing in your startup, the fund of the limited partners, because you are known to me or some nepotism is there. It is just like this that I like that startup. These are the parameters. These are the section of the companies, and we are going to invest in that company. And we are sure about it. Full stop. How much you want? We want to have a ticket size in between 12 crores to 15 crores. This much money I want to invest in your company. Now you tell me that with what figure you are comfortable. 12 crore rupees, we are interested to buy this much share. 15 crore rupees, we are interested to buy this much share. This figure was also approved by the committee, which was there on behalf of the VC firm. So there are a number of things also from the point of view of the VC funding. That is what we say that the capital call, when the capital call is there, they are calling for the capital from the LPs. What would be the investment duration? Then after the harvest period, we are collecting money, and then after we are giving back to the LPs. So startup scouts are there, those who are responsible to understand and to select some of the good startups whose pitch deck may be presented in before the VC firms or not. About the proper due diligence, both soft and hard, that is important. There are a number of consultants which are hired by the VC firm just to go for the soft kind of due diligence. Hard DD we all do, but whenever the soft DD is required, there are a number of things which we do. Whenever, many times it happens that I go and I interact with the startup, I talk something foolish. Maybe I will be asking you, what is IoT? I don't know about the IoT. It is just to understand that how promoters are going to take this thing, how they are going to behave with me after this. So many times it happens that we try to become, a person who is not ready to unlearn, or we are rigid, and then we try to understand just to check the soft due diligence part of the promoters. Power law, we are here for the power law, and responsible VC firm are very much required for the development of any strong nation, and in India we require it, right? So these are the points which are required for any VC firm. Now, again, the steps are same, major steps are same. Again, I wanted to repeat it to you. So now you will be able to understand it in a better way, that how the investors ready firm we make, then the valuation, pitch deck, clarity of the investment, until the closing of the term sheet. Now I will take 1 or 2 minutes only into this IPO. In India, investment of the IPO, that is also become very popular. So we are having main board, as you know, you go and you invest in the companies which are already traded. But in SEBI in the year 2012, there were both the markets, NSE and BSE, they were also open for the small and medium enterprises. In NSE, it is known as NSE Merge, and in BSE, it is known as BSE SME. So what is the important part is this, that if you are having post-issue paid-up equity, that generally you say it as a valuation, of 3 crores and above, and not more than 25 crores, 3 crores and above, you can get your money, you can get investment from general public via IPO, that is initial public offering. Things are very basic. Only you need to take some consultation. Even if you want, we can have a good consultation with you. But the only thing is that you should be able to show us that your company is having a good investment and the good valuation, so that you can claim that your valuation is more than 3 crores of rupees. And not only in writing as a paid up capital, but yes, if you can show, you can assure it, then there are some formalities which are required, and you can also get a good funding from the market. So total, 50 number of minimum members are required, that is investors are required. If you are already trading into the market, you must be knowing some of the companies which have performed very well. The minimum ticket size is 1 lakh of rupees. It can go anything beyond 1 lakh of rupees. So there are some responsibilities pertaining to the underwriting by the merchant bankers and the type of investors which can invest. But yes, this market is also going very good way. These are the only 8 steps when you, as a startup, you go and you try to raise funding from IPO. And these are in the main boards which we have seen, that is startups which were registered in the main board. Here it is not the IPO SME. And only in the year, this year only, 2024, we have seen number of companies which have registered with the SME IPO of BSE market. So these all are the steps. Next number of things are there. So in some other way, we will be talking about it. But as far as this topic is concerned, I hope that I have covered everything related to angel investment and VC funding opportunities for early stage startups. My name is Dr. V.K. Arora. If you want to connect with me, you can again come back to me through email. My email is connectvkarora@gmail.com. Any questions, please?
Thank you so much, sir. Dear participant, if you have any query, you can ask. You can unmute yourself. We have 5 to 10 minutes for the question and answer session. Yes, Deepak ji, do you want to ask something?
Gaurav, you are not able to hear him properly.
Yes, sir. I am also not able to listen, sir. Deepak sir, you can type your question in the chat box also. Because you are not audible. Any other participant? Yes, we will share the PPT. If you have any query related to angel investment and VC funding opportunity, then you can ask.
One question is there about the angel in the Shark Tank. So I hope Shark Tank, they are talking about the show which is there, a TV show Shark Tank. So in the Shark Tank, you will find number of angel investors or maybe representative of any VC firm. So they are a part of this test. They are asking some questions and then after they are offering that they are interested to invest this much money in your startup. So yes, what you can say that in the Shark Tank, you are having number of angels who are interested to invest in some of the startups and they are spotting it. They are trying to search a good startup for their investment. So this is how only they are related.
Anuj, you can unmute yourself to ask.
Am I audible, Gaurav?
Yes, sir. Yes, sir. You are audible.
Anuj is asking that who we can consider an angel investor. So again, I would like to show you my slides. I have just stopped it. But anyone, me also, anyone, Gaurav sir also, anyone can become or maybe interested. But the only thing is this: you will have to understand that I am a serious kind of investor. I am a serious kind of investor. So generally in India, you can expect anyone who is having money or interested to fund. I will not go only for the HNIs or high net worth, kind of investors. But yes, I have seen number of investors who are just investing 5 to 20 lakh of rupees, and they are known as angel investors. So it is nothing like this that we are going to certify anyone that yes, they are angel investors, and they are not. If after investing on the company may sometimes go on loss, they do their overcome in the situation. No. Say this is the investment. If you are going to invest in any property and property is not going to give you any result, then what will you do? Nothing. It is an investment. So investment can also go for the profit. It can also go for a loss. It is not going like this that they are going to come back to you and asking you for their fund. So whatever they can do it prior to the investment, right? But once you have received the investment, uh, you will only have to abide with the agreement, which is generally known as, share purchase agreement or share holders agreement, share subscription and holding agreement, and move on. So invest. That is why I was emphasizing on the term, accredited investors. So they also understand that they are going to invest and what the investment means. Investment doesn't mean that it is profit all the time. It is not a loan, neither a soft loan nor a grant. So it happens like this. So there is one question that, sir, if I have some idea in my mind in my startup, how should I proceed? So if you are having any idea in your mind, then I will say you to make it proceed. Go ahead with this. I have shown you the major steps. Number one is make a good minimum viable product or good minimum viable products, which are having a good scope to run through the minimum lovable product. Then after, you will have to make a company. Please make your company only after your product is ready. I have seen that number of the times from the government schemes also, it is seen that people make company and then after they develop their product. So it is not a good idea. So make a good product, good viable product, minimum viable product with a good value proposition, then only you incorporate your company or LLP. And then after, you should go for after company incorporation, you should go for the product, differentiation, some moat kind of thing, good product market fit, have a good growth hacking strategies so that quickly you make it a, investor ready fund, investor ready startup. As soon it is an investor ready startup, then you can consult your mentors, your incubation center, or come to us. We will be understanding your startup, and then after you see that we can present, you can be presented to which kind of investors. So this is how we can go ahead. But at the early stage, please don't expect investment. If you want to get for some funding, it is better to go for some grant or maybe some soft loan kind of thing. investment should be at that stage when you are ready to have a good bargaining power and with the investors. Just a minute, some questions are on the back side. So what are the potential risks or downsides for startup taking angel investors? So risk is only this, that here you are going to sell your equity, nothing else. And it should not be like this, that in India, what I have seen, that number of startups, they affect to sell their strategy, their equity, because they think that getting 10 lakh rupees against 2% equity or 3% equity, it is a loss from their side. So here I will suggest you in this particular point that having 100% equity of your startup, which is not giving you result, is useless. And if you are having only 20% equity of a startup, which is having a good revenue, that is useful. Don't stick to not to sell to your equity. So it should be a company which can be represented. So this should be the main motive. So potential risk is only this, that people, you will be selling them equity, or maybe they will be interfering you, as I have already discussed with you, to your day-to-day discussion, but which you will not find in the case of VC funding. But in angel investment, generally they will be asking you to give you annual operating plan. And you know, there is some structure of annual operating plan. If you require, we can send you the annual operating plan. And accordingly, they expect you to work. And if there are any changes you are going to make, they also expect you to inform them in prior. So what will the bank be categorized as angel investors? No. In India, banks are categorized only for the loan. But if in the financial institutes are there, financial institutes, then from Japan, this story has come that financial institutes, which are also known as bank there, they are also providing you loan. They are also investing in your company. In India, also some of the banks, I know HDFC Bank, ICICI Bank, they are also giving you some grant or maybe interested for some investment. So that scenario has been started in India, but not in a good way. So actually, this is the difference between bank and financial institutes. Banks are not going to be categorized as angel investors, but financial institutes are supposed to be. I think one last question is there. To investment, we should have enough money. Yes, we should have invest money if you want to invest. SEBI also qualifies that if you are having 1 crore rupees for the investment, then only you will be categorized and you are considered to invest in some of the money. There is some category, and that is there. But to start with, for this question, I will be suggesting you to come and meet personally. Then after, I will be able to explain you in a good way. But yes, if you are going to invest through the AIF instrument of the SEBI in-laws, then the minimum category of 1 crore of rupees, that much money, that much corpus you should have with you in any of the category to category if you are going to invest in any of the startup, and not only the startup, in any of the project. Any other question?
Sir, chat box is also have some other question. Praveen Kapoor sir also asked a question: what is the potential risk of downside of a startup taking angel investment?
I've also already answered that question.
Okay, sir.
I hope.
Anuj has asked, will the bank be categorized as an angel investor?
I've already answered one of these questions.
Okay, sir.
I was audible no? During that time.
Yes, sir. Yes. So, Garima ma'am has raised the hand. Garima ma'am, do you want to ask?
Yes, sir. Good morning, sir.
Good morning.
Arora. Sir, one practical question I am willing to ask. Actually, what happens when anybody enters in a small businesses and somehow it happens that they used to burn their money first, then they go for the investors. Okay, and they don't target the single investor. They send their business plans or whatever the summaries are there to 2-3 investors, because it's not a guarantee that all people are going to respond. So sometime it happens because it happened they ask the question have you submitted your summary somewhere else also? So the situation become critical for the business owners to give the answer of it. So my 2 queries are there. What should be done in that situation? Second, the time these investors used to take private equity and venture capitalists, it's a long one. So how a person should plan the things for, let's say, 6 months and 7 months, how the funding will be managed. This is a very regular question which comes to us when the student startups are there.
Okay. Garima ma'am, 2-3 points are there which I have understood from your question. I would like to answer it in such a way. First of all, if you are going to send your pitch deck or your pitch video or your business plan to any of the investor, we always suggest startups to do it in consultation with your incubation center or mentor. We are having, ma'am, a good list of angel investors and VC firms, those who are directly in connection with us. So if we get it, we understand that your startup is a startup where you may get some investment. So it is better to go through with via a channel. It is not a good idea to just email to all the angel investors email ID that this is the pitch deck and we are going to actually consider, we are going to looking for some investment from you. And many of the investors, they say like this, that every day they receive 5 to 10 pitch deck and with the same writing, and maybe on the BCC copy they are send it to you. Sir, I am looking for this much investment and this is my pitch deck for your kind consideration. These are my contact details. So please don't do it. You are looking for some investors. Please understand that investors are also looking for good projects. I'm repeating it. Investors are more inclined to get good startups. That is why number of squads are working. They are deployed some of the squads just to understand, just to select some good or capture some good startups. Point number 2, if you are going to pitch before any of the investors, there is a one format, although that format is not of much use, but yes, there is a one agreement that whatever you are going to discuss with the startup, with the investor or investor with the startup, that thing will be kept between you two parties only. Means it is such kind of non-compete agreement. It is a kind of non-compete agreement, but not a non-compete agreement. Yeah, you can sign that kind of agreement. The format is already there. So if anyone is going to, showcase their startup with the Shark Tank, Shark Tank, or maybe any other such kind of shows, then too you are supposed to sign such kind of agreement. Now, when coming to the last question, that how long it takes and how it actually works. So generally, it is said that any investment should be completed within 6 months of time. It should not go beyond 6 months. Good time period is a 3 months time period, but maximum it can go for the 6 months. You may have 4 to 5 kind of meeting. Investors also would like to understand your project. They go for the due diligence process. Due diligence, all the startup will go back. This is 100% sure. And if you take up, it may take up to 2 months of time. So total 6 months of time. So the only thing is this, you will have to talk to them, and then you should be able to understand what is in their mind. Are they really a serious kind of investors or not? I use this term when I was taking a session, serious investors or not. Many times it is seen because I represent women entrepreneurs based incubation center. So many times it is seen that people, they ask to meet our entrepreneur at different places once, twice, and thrice. Then too they are not investing. So it should be very clear to you that ultimately they are investing. They are also having their own interest, and which should only be related to the return on investment and nothing else. So that is why serious kind of investors are also you have to understand. Summarizing everything, Garima ma'am, I will suggest you always to take advice before you go for any kind of investment, because a lot of fraud things are there. People, they also come and they also try to understand your business idea, and ultimately your moat will no longer be moat. It will be disclosed. It will be open to everyone.
Yes, sir. That challenge we people were facing actually. Thank you so much, sir. Thanks for the advice and giving the answer to the query. Thank you, sir.
Thank you, ma'am.
Any other question? Okay. So once again, thank you so much, sir, for
Thank you,
delivering this exceptional, informative, and highly engaging session on angel investment and VC funding opportunity for early stage entrepreneur and startup. So your insight and expertise provided a valuable knowledge to our participant. and helping them better for the understanding to secure the funding and to plan a strategic approach necessary for their entrepreneurial journey. So I would like to request our Director IQSC and Vice President of Institute Innovation Council, Galgotia University, to offer a token of gratitude for our speaker. Meenakshi ma'am. Okay.
On behalf of Galgotia University, we extend our heartfelt gratitude to our esteemed speaker. It has been an honor to have you with us today. Your presentation has provided us with a wealth of knowledge and inspiration, sir. Please accept this memento as a small token of our immense appreciation, your time and efforts. Thank you so much, sir.
Thank you, ma'am, and namaskar, ma'am.
Thank you, sir.
And thanks to you, Gaurav sir, and to all the faculty members and students, startups, incubators. Thanks to all. Thank you.
Thank you so much, sir, for accepting our invitation. And so we are moving ahead. And our next speaker also has joined with us, Dr. Ashutosh Pastor, sir. Good morning, sir. So let me introduce first our speaker. Dr. Ashutosh, sir, is currently working as head and senior manager incubation in the Foundation for Innovation and Technology Transfer, IIT Delhi. Previously, he has worked as a manager biotechnology business incubation facility in FITT, IIT Delhi, and he was the visiting scholar, University of Pittsburgh, USA. He has awarded PhD in biochemistry and molecular biology from IIT Delhi and received MSc degree in microbiology from Jivaji University. He has published several research papers in highly reputed SCI Index journal, and we are very fortunate to have you in this session, sir. So you are welcome, sir, for delivering the keynote talk. Thank you, sir, for accepting our invitation also.
Yeah, thanks, Dr. Gaurav, and a very good morning to all of you. And thanks to Dr. Arora. I think it was a very insightful talk with enough technical details on fundraising. So what I'll do is, because Dr. Arora has covered a lot of details about the general aspects of fundraising and a lot in terms of details also. So I'll try and cover primarily like in terms of the approach, how should be the startup's approach to reach out to different investors, and then what are the certain points that you need to take care specifically when negotiating with the investors. So I'll try and cover that part, and then maybe because we are also having an investment fund of our own at the office, and we also manage a lot of different funding programs for early stage companies. So I'll highlight a bit on that part too. But before that, I just wanted to know, I mean, we have more than 100 people in the audience. How many of you have already registered companies as of now, or are planning to have a company in the next 3 to 4 months? If you can just give a show of hands to me, that would be helpful. I hope the attendees can at least give a show of hands. Okay, great. Arush is one. All right. Anyone else who is already having a registered company or plans to do that very soon? All right, sure. So it'll be more of an informative session for you, and maybe you can get into action later on. So I'll quickly start with a short introduction of what all we do here, and then I can go ahead to the topic. I'll keep it short, but we can have more interaction and Q&A once I'm done with the particular thing. Right. So I hope I'm allowed to share my screen now.
Yes, sir. Yes, sir. Sure, sir.
All right, you can see my screen, right?
Yes, sir.
And the slides are moving?
Yes, sir. It is moving.
All right, thanks, Dr. Yeah. So just a quick intro. We at FITT at IIT Delhi, we started as an industry academia interface. We do a lot of different things with industry, take care of patents. We partner with industry, and we also manage IPR and startup incubation and research parks. And till now, we have incubated 200 startups, but supported many more through different funding programs, mentoring sessions, boot camps, and all. And in the past few years, out of the 200 startups supported, we have like got a reasonably good success rate with more than 50% of the companies that we have supported surviving in the longer run. And currently the total valuation exceeds 500 million USD, and some of them are expanding internationally. Through our own efforts and different partners, we have till now infused $24 million funds in different companies, and many of these have raised follow-on fundings also, and more than 100 IPs have been filed. So this is what we do across the board. So I'll not talk too much about that, and we'll move mainly to the topic today. Now, fundraising is an important aspect for each startup, specifically for first generation entrepreneurs, because in the first generation entrepreneurs, we may not have a background of capital in case we are business families, we can put our own money. But for first generation founders, especially at technical institutions, we need a lot of capital to raise when we want to venture as a startup. And if you're building a hardware product, the requirements kind of can shoot up more, and you need specific facilities and all for service companies and software companies. Also, they need a lot to invest in manpower, particularly, but the timeline could be shorter. So that ways they can save a bit. Now, if we do a survey among startups, and this I've got from a NASSCOM report that was quoted earlier, most of the startups say that access to early stage funding and other funding options is one of the important enablers in the startup journey. And I think that's the topic we're going to cover today. So at a very early stage, when, as most of us today who have joined the call are in academics, so for basic research and applied research, to an extent, we can get funds from the government projects or some funds from our own universities to take care of the early stage research. But once you complete that basic research, when you start going towards applied research and tech development, in that stage, at times, the academia and government funding was not very much available at that stage, but those times have changed in the recent few years. And now we have multiple government programs available, even for people from academia, researchers and faculty members, to get funds for product development. For example, particularly DBT has the ATCG program, or BIRAC has the PACE program for faculty members, where they can take care of these early stage opportunities. And once you are done with that, then you can reach out to investors. And there are multiple funding programs also available from the government if you're actually looking to venture into entrepreneurship. So those are funds given to people who are actually venturing into entrepreneurship full time. Some of them need a registered company, some of them may not need a registered company. So we'll discuss about that as well. Now, most of you might understand the funding options that are available for startups. I'll just quickly cover these. This is very generic, but specifically from a risk perspective and pressure perspective for a startup. So you can divide the funding options into three major categories: grants, debt financing, and equity financing. So grants are basically money that is given to you with an expectation that you'll be able to contribute to the economy later on. And it's kind of a grant in it which has no component of return to be done. There's no risk and no collateral involved. And thus you can just maybe, the only thing you'll have to do is wisely spend it, and it's mostly given in tranches. So if you perform well, you'll keep on getting the next tranches till the committed amount is already provided to you. And there's no involvement in decision making from the funding agency side. Only thing is they'll monitor your progress, and in case the progress is fine, they'll be giving you more funds. Debt financing is another model where you don't need to give equity. So, but grants are also available for individuals. And as you move to debt financing and equity financing, you'll need to have a registered startup to be able to take these funds particularly. So debt financing is more like a loan where you have to pay back the loan and there'll be an interest component involved. But this is also not very easily available for early stage companies. So grants and equity financing is what you should look at. Debt financing is good for companies that have started meet the due diligence norms of different banking and non. Hello, can you hear me? Can you hear me? I think there was a connection error in between.
Yes, sir.
All right, I'll just share it again. All right, apologies. I think there was some network error. So I think Dr. Arora has already talked a lot about equity financing, and most of you are clear about that. So the risk factor for the investor is much higher compared to the risk factor for the startup itself or the innovator, because they are primarily giving shares in a company. But if the company does not perform well, investor has equal risk. Founder has risk of losing their time and all, but investor, because he has put in a lot of money, they have also a greater risk. So there's no pressure for repayment in equity, and returns to investors are more in terms of capital growth as the company grows. And in some cases, equity investors would like to be involved in decision-making process of the company. So that is the only catch situation here, because once you take money from investors, most of the investors would like to keep a closer track of the company because they will be gaining or losing their money. Thank you. All right, so I'll move ahead then. This is a basic timeline at what stage you should reach out to which kind of investor. So at an early stage, when you're basically in a stage where you are only losing money but not earning money. So at that stage, you generally seek seed funds, and these days, most of the seed funds come from government programs. Once you've started generating revenue, but still your burn is more than your earning, so you're still not at a break-even situation. In those stages, you reach out to angel funds, and then once you start getting a little more revenue, then you reach out to smaller VCs, debt funds, and others. Again, these things are variable, but this is the general trend. I think this part is also covered to an extent. So you can reach out to venture capitalists who generally invest through a firm. So there'll be one VC firm, and they'll have their LPs who are investing, putting money at the firm and making collective decisions to invest the money. Incubators and accelerators like ours, they also provide resources for pre-seed startups and seed startups. So many of us are running early stage funds, and then we are also investing in growth stage companies to an extent. The angel investors are mostly high net worth individuals who are investing in more riskier startups. So they come before venture capitalists when the risk is a little higher. That's why we call them angel investors, because they work with you at a stage where where they are taking a lot of risk. So they come as angels to you. But then small business loans, and then equity-free financing that's done through, again, like in terms of debt. And also, like there are types of equity financing instruments. So I'm not talking about grants and loan here, but when you give somebody shares that are also like given in 2-3 different forms. So one is you can give it in the form of convertible notes or CCD. So this is basically kind of given as a loan that will be converted to equity at some point of time. And those terms and conditions are defined right from the beginning that this is how it will be converted. There's also some discounting involved. So for example, I'm giving you some money at a very early stage. And I, for example, commit a 50 lakh rupee fund to you at a 5 crore valuation. So that becomes kind of a 10% thing, but I'm not going to convert it right away. So I'm going to give it as a convertible instrument right now. And later on, when you do a next fundraise, a valued round, at that point of time, it can be converted. But now till the valued round, your valuation would definitely increase to an extent. To cater to that, at times, investors who are investing in convertible notes or CCDs, they ask for certain discounting. So that is okay because I'm investing today, and if it's going to convert after a year, the valuation will definitely shoot up. And I'll also lose some interest in case I would have kept that money in my bank. So generally, a 10 to 20% discounting is the norm that is given. At times, if the fundraising is further delayed, the discounting percentage go higher. Our cap is basically that even if the valuation reaches much higher, we'll convert at this particular value. So there can be a floor or a ceiling for these. Then the conversion happens in either a common equity stock, which is giving ownership and voting rights also. And then there's a preferred stock, which is not having particular voting rights, but then they have additional benefits. So in case the company is liquidated, they'll have the first right to take all their money out, and then only the other investors will get whatever is left after that. This is average dilution that happens during fundraisers. So seed round can be up to 20% dilution. We generally suggest to do not more than 10%, but up to 20% could be done. Then Series A round, again 20% dilution can happen. It can be slightly more also. Series B is again 15%. So generally, after reaching Series B and C, the founder's equity can come to less than 50%, but that's fine because then the company grows to a stage where even that equity is reasonably having a much higher value. So in terms of how long does it typically take to secure angel investments? We would prefer having in the lower bracket. So preparation stage is one where I'm actually reaching out to different investors and identifying potential investors and preparing your pitch decks, preparing your business plans, preparing your projections. All that takes a lot of time. And then you start interacting with investors. The evaluation process of investors will take some time. They may not invest in you in the first meeting itself. They might want to follow you for some time, maybe a couple of months, and understand whether the startup is really progressing well, or at least get some time to know you better. And then once they are okay with the deal, they'll also do some due diligence, and then the term sheet happens and the negotiations happens. The term sheet is basically a document that mentions all the terms and conditions of the particular fundraise. So at what valuation, what conversion, how much money will be provided, what all terms the investors want, that will eventually go to your shareholding agreement. So all that is provided. So term sheet is basically a document where you can go back and negotiate with the investors, and then you sign the SHA after closing the deal. So there are multiple factors that you need to consider in the term sheet also in terms of either the investors are asking for a voting right or preference shares, or are they asking for board seats, how much valuation they were providing. So on all these factors, you have to negotiate with them based on your own priorities, what you need. You can maybe like provide some discounting to investors on some of those points while keep your hold on some of these points. So again, the negotiation is also an art that you can learn when you actually go to investing, that what really matters to you more. Is it your valuation that matters more? Is it the board seat that matters more? Or what is the factor you really need to consider? Now, it's very important to know the investors. Now, there are like hundreds of angel investors and VCs even thousands of them in the country these days, and many of them have like structured mechanism and registered funds to invest in companies. But most of them have different mandates and criteria. So the major things that you look for in terms of knowing your audiences, that one is to which investor you're pitching to. Do they really invest in companies at your stages? So investors generally have, based on their previous fundings that they have done, you can identify certain trends before reaching out to those investors. So if an investor invests in seed stage companies, and if you're going to them for a VC stage funding, it will not work. If somebody invests in a higher quantum, and if you're going them for a very early stage funding, it may not work out. So at what stage they are investing? Do they have any specific sectors of interest that needs to be taken care of? So every VC may not be investing in all sectors. Some of them might, for example, be investing in only climate companies. Some of them might be interested in retail. Some of them might be investing in SaaS and AI-based companies. And some of them are open actually, but still based on their previous investments. Before reaching out to your VC, you need to do this homework beforehand, that you try and see what are the type of companies they have invested in the past few months. And based on that, you can identify whether it's the right investor to pitch for. Again, your incubators can also help in this case, because we are interacting with a lot of investors, and we keep a database where for what type of companies, which sectors, at which stages, which VCs are the right people to reach out for. And accordingly, we can do that matchmaking for you and then connect you with that particular VC. Right. And then based on the audience, you need to also customize what you're going to pitch to them. So at different stages, for example, if you're pitching at an idea stage, your problem statement and business plan is more important. If you are asking for product development fund, you need to include enough technical details. If you're asking for a seed stage fund, your detailed market understanding and revenue and growth projections. If you're pitching for a scale up, then the traction that you've received till now, plans and partnerships will be important. If you're making a sales pitch or elevator pitch, the focus varies a little bit. So it's very important to understand to whom you're pitching. Now, you need to also develop relationship with investors. So as I mentioned, do your research and understand if the person is the right VC to reach out to. Sending a cold email may only work when you're really good and your pitch deck tells a lot, but that generally does not work. The important thing you can do is get introduced to the VC through your incubator or through another startup that the VC has invested in. And that interaction can give you more time actually with the VC to discuss. You can also attend a lot of events. So many VCs attend events. So attending events is a good way to network with the VCs. And then you need to keep doing follow-ups, or at least send them updates. So once you have met a VC and spend enough time with them and they know about your concept, if they are interested, you need to do some follow-up things. Do send updates if there's some progress in the company. Do send updates on those progresses. So it caters to two things. One is the VCs regularly are aware what you are doing. And the other thing is it kind of works as a follow-up that I'm interested in fundraisers, and you can consider us. Now, these are the general practices that you need for securing angel investment. And this is, again, goes without saying for most of the fundraisers, even for early stages or late stages. You need to develop a solid business plan, a good team. Many investors invest in people, and that's one of the most important criteria. You need to conduct thorough market research. If you're not completely aware about the market itself, that will work against you. So better knowledge about your market, about your competitors, as much as you know would be better, because then you'll be prepared better to mitigate the risks inherent with the competitors and other things. And then you need to show tractions and milestones, have a clear revenue model, network and build relationships with angel investors. As I mentioned earlier, be prepared for due diligence. Now, for due diligence preparation, you need to take care of your documentation in the company, set the right processes right from early days. At times, startups don't take care of those things, and then when they go to a due diligence, at times they might not have completed some legal compliances or financial compliances, and that becomes a challenge for them at a later point of time. So understand those things and also be prepared for these kind of due diligences. If the processes in the company are clear, fair, and transparent, it's easier to complete all these due diligence processes. You need to be realistic with your valuation. Now, again, there's no clear valuation as such at all times. It's mostly what you're able to negotiate with the investor. You have to put a valuation to them that this is what we are going to do. That has to come based on one of the established methods, could be discounted cash flows or other methods that we use for valuations. In early stage companies, especially for angel investors, if you don't have that kind of a revenue, then your market projections mainly work for you. And if you have an IP and all that, but again, those are hypothetical numbers only. So you need to be realistic and you need to be open to negotiate on the valuations based on how much this delay in fundraising can actually hamper your plans to grow the company in a real base. Then you need to be transparent and effective. Effectively communicate and share your vision and values. Again, there are certain differences at different stages. As I mentioned in the early stage, know your audience also. So angel investors and VC funds might look at different things, but one important factor is the quality of team, which is most important. At an early stage, they might look at your business models, but VCs will look at a product market fit because you're already in the market there. Your defensibility matters in the longer run. So these are certain parameters where at each stage, somebody will weigh in some factors more than the others. So depending on at what stage you're doing the fundraise, you need to kind of cater to these things and accordingly highlight the important parts more in your pitch. And then there are certain things when that's where what not to do. So if you're not preparing well, if you're not doing enough research about the VC, or you don't understand like what the VC is looking for, that will be a big mistake. So VCs like people who are already prepared and understand what they are pitching for and understand the market well. You should not ignore your competition, because if you're not aware about your competition, that kind of comes as a turn off. VCs generally keep on following a lot of companies in that area, and most often than not, they will be aware about the competition that exists out there for you. So if you're not aware about that, then again, you'll kind of be seen as not prepared well. And then why does your competition, why is your competitor successful, or why he or she is not successful also matters, because the market dynamics can be understood based on your competitor's success or failure, and what kind of products that put in, what new are you building in to mitigate those risks that they did not maybe look at. So all that would be understood once you know your competition well. Asking for an NDA is fine, but then if you're doing something which is not very technologically groundbreaking, you may not want to ask for an NDA, because then it will delay the process and maybe you might lose that connect initially. Not having an investment plan is also not helpful. So you need to go prepared with an investment plan. That why are you raising this investment, and by what time would you be giving exit? How much growth you're targeting? When do you expect your next fundraise to be? All those factors are to be considered. Then aligning yourself with everybody else's performance also. So I think that's also not very important. But then to convince about your own performance, you need to kind of be clear. You should know about what your peers are doing, but don't just keep on comparing with them, and that will be important. You should not expect your investor to understand your idea all the time, because many of them may not be technically sound in certain areas, while investors, based on their areas of interest, do have some technical knowledge and they do try to understand. They might later on go for a technical vetting through a technical expert for the technology that you're working on if it's a deep tech. But don't try to go too much in depth of the technology. Primarily focus on the application. When they might ask you for a technical validation or might ask a technical mentor to meet you, then you can talk about the technology. But here, if you're talking to an investor, your pitch should be more in terms of your business plans and projections. Again, if you're trying too hard to convince your investors, that's also not very good because they understand that you're very deliberate to raise funds at this point of time. And at times they might lower your valuation or those things. So one of the best things is to try to progress the startup as much as possible either in terms of product validations or in terms of focusing on getting more and more customers. Because once you start getting customers and some traction, investors will definitely keep on following you. So a lot of startups we see, once they start getting tractions, the investors automatically start showing interest. But if you're just focusing on fundraising and those fundraising efforts are some way dampening other efforts of getting more customers and all, that's not really a good thing, because your traction in the market will help you in terms of getting to more and more investors. Finding the wrong investors, again, this we have discussed. Having too many processes in the company. So while you need to keep enough processes to maintain the basic due diligence requirements, but too much is also not really important. And you don't need to offer too many details at an early stage meeting. And that could be done only at due diligence if required. So these are the basic things that you need to take care of. So I think because Dr. Arora had covered a lot of other points, so I'll not talk too much about the specifics and the legalities of investment, but we can have Q&A if required on that side. What I'll do in the next part of this presentation is that I'll cover a few early stage funding support. Most of you are not yet even registered as companies, so this might be useful for some of you, and then we can take the questions. So there are a lot of support programs available through the government side, through DST, METI, BIRAC, MSME, and these are some of the funding programs that our team manages directly, where we can also help you in raising funds. And many of these are available to people who have not also registered companies yet, at least for the ideation and immersion, product development and validation stage programs. Once you reach to pilot scale and investments, then you need to have a registered company. There's no point going to a VC without having a company registered, because you won't be able to offer any shares to an angel investor or VC. So at an early stage, you need to go to the right programs. Again, the way we were discussing, you have to identify the right investor. A similar way, you have to identify the right program or the right stage you need to apply to a program. So there are programs like BIRAC, Sparsh, for that matter, for students who are just graduating out of their degrees, which is more of like a fellowship program for 18 months, which give you 50,000 rupees per month fellowship. So the first 6 months you just spend in identifying certain problems, and after 6 months you can submit 3 problem statements and solutions for which you're going to work. And based on the selected problem statement, then you get another year and a 5 lakh rupee kickstart grant to start developing that. And your fellowship continues for the entire 18-month duration. Likewise, Samsung Solve for Tomorrow is a program where I think there was an event at your university also. So that's also for early stage. Even students who are currently doing graduation can apply to it. And then at times we keep on doing hackathons, and then there's awards in different sectors, which also give you cash prizes, which you can use maybe to start developing certain products that you're trying to develop. And then there are many programs in product development stages. Maybe some of those I can talk about. So most of you might be aware about the Startup India Seed Fund program, which is directly the application is directly done on the Startup India website, and there are multiple incubators across the country that manage this fund. There's a 20 lakh rupee grant in aid available under this fund, and a 50 lakh rupee investment available under this fund. But you need to be a registered company with a TPIIT registration for this, and then only you will be able to make the application. And also, you have to apply within 2 years of registering your company. So one of the points that Dr. Arora had mentioned is you register a company when you feel that you're actually now going at a stage where you need to accelerate your product development and fundraising. So all the initial research, basic research, applied research, and early stages of product development can be done before registering the company. When you have something concrete, a plan, then you register a company and then you reach out to all these funding agencies, because there's a lot of competition, and without concrete plans, it's very difficult to secure these funds. Then AICT also does this Smart India Hackathon that also funds early stage people. So again, in this case also, you need not be a registered company. You can apply while being in your college, and you can secure some funds under the Smart India Hackathon. So again, it happens every year. Maybe last year's edition happened in December, so this year again it might come. Then DST Nidhi seed support is available, but for this you need to have registered a private limited company, and the investment fund is up to 1 crore per startup. And again, this is done through incubators. You need to check incubators that have the seed support available, and you have to reach out to them. And this is given to startups who are at a stage where the minimum viable product is available, and the startup is now at a stage where they are going to start reaching to customers very soon. So this is not for product development, but once the product validations are done, then you can apply for this. Also, your state governments have certain funds. So I think UP Start in UP also has certain funds available where you can either apply as individuals also, but in most of these cases, you need to apply as startups. So I think most of you might be aware of these, but they also give sustenance allowance to founders and startups. There's a prototype development fund available. There's a seed fund available. They also give funds for event participations and patents. So because your university is in UP, so you can probably avail such funding mechanisms also. And then for life science companies, this BIRAC Seed and Leaf Fund, there was a 30 lakh rupee support for companies that are in validation stages, and then 100 lakh rupees available for fund companies that are now at a stage where validations are completed, or early revenue stage companies. And probably these funding quantums will also be raised in the next year. Biotechnology Ignition Grant is one program that is currently open till 10th of June for applications. And here also, anybody catering to anything related to life sciences, they can apply. And even individuals who have completed graduation can apply. Faculty members can apply without registering a company. Or if you have a registered startup that is registered within the past 5 years, so then you can avail this opportunity and apply to this program. So again, for this also, the application is open on the BIRAC website, and FITT is also one of the implementation partners here. Then IDEX is one of the programs that is launched multiple times in a year. So they launch Defense India Startup Challenges, and there are very specific challenges in terms of what product is required, or if somebody feels that their product can help the defense forces, they can also apply to open challenges. And this is done through the IDEX website. And this is more of like a co-creation program with defense establishments. So either the Army, Navy, Air Force, or defense PSUs, they give you detailed detailed specifications for the product, and they'll also keep on interacting with you right through your journey. And also in case you need some system integration at the user end, and also those kind of supports are provided. So in the disk currently, there's a funding of 1.5 crores available. Then there's a Prime, which gives you funding up to 10 crores. And then there's Aditi scheme, which is launched, that also funds 25 crores plus. but there's a matching contribution requirement. So you'll also have to do some private fundraising parallelly. Tide is also one of the programs which will be open very soon. So we are going to launch certain grant challenges under Tide very soon, maybe in the next 1 week's time, so you can follow. So there's funding available of 4 lakh rupees for people who have not yet registered companies. They can join as entrepreneurs in residence, and for registered companies, they can get a funding up to 7 lakh rupees. So this grant challenge will be launching in the next week itself. And then there are certain programs, CSR programs, like the Sona Comstar ITL Innovation Program for Clean Mobility. So this also we will be launching in July, again, next year's call. And there's a funding of up to 50 lakh rupees available in this. And you can apply as an individual, but if you get the fund, you'll have to register a company before receiving the fund. Likewise, we're doing multiple accelerator programs also. And the Boeing Build 2.0 is also in aerospace and sustainability. So a lot of such programs are available. The Pfizer Innovation Program will be launched very soon. So one edition with NIPERS was already launched, and 31st May was the last date. And for the larger edition that we launched with Social Alpha, so that will be launched soon. And then there's a XR program that was done with Meta. As of now, the next edition is not clear, but this is also an opportunity. And then I'll just take you through some of the startups that we have invested in till now or supported them. In most of these, we have invested also. So in Botlab Dynamics, we invested early on, and the startup does drone shows. If you've seen any of the drone shows, they now have a world record of flying 5,500 drones in sync. And the startup is progressing well now. Siren AI Solutions is also one of the startups supported by us. And they work in the domain of AI and cyber physical systems. They are now they've now received orders from defense to cater to certain needs of theirs. Vecmocon is also one of our portfolio companies where we invested. So they work into different components of e-mobility, and the startup also raised around 40 crores rupees from Bloom and Tiger Global after our initial investment. So they're doing quite well. Auric Nanosystems is one of the health tech companies. So they started making these small hemoglobin readers, and they have not raised considerable investments, but their revenues are growing steadily. So now the startup is generating very good revenues. And then there are certain startups in social sectors like Fruvatech, which works on delaying the ripening of fruits and vegetables, so you can store them for longer, or even the loss that was happening during storage and transportation. So that is being mitigated to an extent. So less losses happening. So startup is getting good traction now, and we have invested in them recently. Then there are certain other startups like Clensta, Sanfi, that were more into D2C products, and these startups are also growing well. And Accure is one of them, where they're working on copper-infused polymers and supplying these polymers to multiple industries now. And FlexMove, for example, was another startup that was also supported through the Biotechnology Ignition Grant. And it's a very simple thing that the base of the crutch mimics the foot, but the design is done in a way that it's really helpful in absorbing the shock, helping them walk on different kinds of surfaces like mud, gravel, and others. And it's also received the design mark award. So there are multiple such other startups where we have supported or invested, and many more in the pipeline. So with that, I would like to thank and stop here, but I'll be happy to take more questions and discuss if there are any specific things you would like to discuss. So thank you.
Can you go back to your previous slide? Just I wanted to note down your email, please. Sorry to interrupt.
All right, no issues. I can write that in the chat box also. Right, so if you guys have any questions for me, I am open to discussion and interaction now. Dr. Gaurav, I hope I'm audible.
Yes, sir. Yes, sir.
All right. Sure. Thanks. All right. So one of the questions is how to register a company. So there are multiple considerations that you need to take care of before registering a company, but registration of a company is just a small legal process that you need to complete. So before registering a company, what you need is basically to be prepared for doing the business, what you're going to do. As I mentioned, you should only register a company where you're clear with your plans. It should not be just an exploratory stage, because closing the company also becomes a challenge in case you don't go really ahead with it. So the second thing you need to do is to find a co-founder or a director along with you. So generally in private limited companies, at least 2 directors are required to begin with. And with your co-founder, both of you can be directors. You can define your shareholding. You need some capital initially to put in as a paid up capital. So there are authorized capital and paid up capital structures. Authorized capital is basically the amount of capital that is authorized by the company to issue shares for. And then paid up is the actual capital against which the shares are already issued. So you need to put up some paid up capital in the company. That can be as less as 10,000 rupees these days. Then you can onboard a CA who can help you with the registration formalities. So you'll have to initially create your directors' identification numbers, board directors. The DIN numbers are issued, then you need to check whether the company name you're trying to register is available or not. Once all that process is done, you need to fill the form at MCA for the company registration and upload the documents. All this process generally takes, if everything is smooth, a week's time, and your CA can guide you for the rest of the things. If you already have a company, you can reach out to angel investors. I specifically highlighted that you need to clearly identify what are the relevant angel investors to reach out to for your particular company. Like, for example, we have Indian Angel Network, who has also created Bio Angels, which are more specifically investing in life science companies. Like some angel investors invest in specific areas like automobiles or clean tech or sustainability, or some of them are more comfortable investing in AI, blockchain, SaaS kind of companies. So there are certain databases also that the incubators have, like Traction is one of the databases that we regularly use to identify what currently some investors are doing and in which sectors some of the investors are investing more. So you can reach out to the incubators and they can probably help you in terms of identifying the right investors for you, and also can do an initial matchmaking for you. Yes. So there's no actually formal channel to apply. It's only that you'll have to reach out, connect to them, and then make them understand about your business model and if they're interested to invest. So there's no specific website where you can like kind of apply, right? Registering as OPC company will be helpful. Again, so OPC is more of like a one-person company, and it's not recommended. If you're actively looking for fundraisers, go for a private limited company. Even in LLPs like limited liability partnerships, you only can onboard somebody as a partner, but there are no shares to issue. So LLPs and OPCs are generally like not considered, but private limited companies with 2 founders would be the best thing if you're going for private equity fundraising. If you have a registered company because of a particular idea, then later I may get a different idea using different domain. What should I do? Same company or new? Again, as I mentioned, closing a company is also not an easy thing. If you get a new idea, you can still pursue it under the existing company that you have registered. In certain cases, for government funding programs, there are certain guidelines that the company should not be aged more than 2 years, for example, for Startup India Seed Fund, or should not be aged more than 5 years for the BIRAC BIG program. So those are the things that may be impacted because your company's age. but otherwise closing a company and starting a new company will also be troublesome. So that's why I said register a company when you're prepared for it. Please provide Angel's contact details. You can reach out to us separately for that, and we can, after understanding your business idea, we can provide you the contact details. How to apply for seed money, and give a few examples that how Basic Idea gets the seed money as a grant. Again, there are some important factors. So one is how to apply for seed money. If you want to apply for a government funded thing for seed money, there are multiple channels. Like for example, for Startup India Seed Fund, the application can be directly made on the portal. But there also you need to be prepared because you have to select 3 incubators through which you want to apply, give a preference. So you need to talk to the incubator first before making that application, whether they have that fund, whether you match their criteria of investing, the kind of sectors they want to invest in. So preparation is the key for everything. Don't apply here and there without being prepared, because that will not work out in most of the cases. Now, the important things that you need in terms of preparation is that how clearly you can convey the message that you're trying to do, what problem you're solving, what is your solution, what's market for it, have you talked to customers, what's your team, is there any IP involved, what kind of business model are you looking at, is it B2B, B2C, what kind of revenue channels are you looking at, is it sales or service or combination. So that preparation is required before making those applications. In most of the cases, you'll be able to find certain templates to prepare and make those proposals and presentations. And we can also share those. The concept of EIR, can it be pursued from a different city? Generally, entrepreneur in residence, the word itself means in residence. So getting EIR funds requires you to be at an incubator. In some of the cases, the funding agency may allow you to be in the incubator of a local city. In some cases, they'll allow you, you'll have to be at the incubator where the funding is coming from. So this varies in different cases. Can a company have 2 brands and raise funds for one brand particularly? Now, the company can have multiple brands under the same registered name, and you can raise fund for one brand, but then you need to understand, because you're raising equity fund, you cannot give shares for just one brand. You'll give shares for the entire company, right? So while the other brand may be even better or worse, if the other brand is better, you're still diluting based on your lower thing. If the other brand is not working well, then your entire calculation will be based on the brand that is doing good. But the shares will be given for the company only. So you can have as many number of brands, but the shares you're giving is you're giving the shares for the company. So that's what you need to understand. I want to be an entrepreneur and I'm reaching the industries and venturing into avenues. Any advice on how to approach a business idea? All right. So again, there are multiple things to do here. One is approaching a business idea requires a lot of preparation. The problem you're targeting to, is the market ready for it? You have to do the 5W1H exercise to understand the market well. And you need to then work on your business model canvas also. All this could be done as a draft in early stages also. You should not say that I've not even reached to the stage yet. Why should I even do that? So while your product development may go parallelly, you should still try and work on your business model canvas. And then you can reach out to relevant industries and all. But again, as I mentioned, if you all are aware enough, then you reach out directly, or you can take help from incubators, because then they're connected with industries also, and they'll help you prepare well before reaching out to those industries. Do tech startups also register through the same process? Yes, the company registration process is same for everybody. If you want to register a private limited, it does not matter what the company is doing. The process to register will be the same. Please tell me Angel's website's name. So I can give you names, but again, without preparation, you should not reach out to them. So for example, now even with city names, there are multiple. There are Mumbai Angels, Chandigarh Angels, Hyderabad Angels, for example. There's Indian Angel Network, many such networks available, but do your homework before reaching out to them. How do we schedule a first interaction with you to pitch our case? Yeah, you can send an email to us. I've already shared our email ID on our website. You can submit a query. So we have a query module on our website where you can write a short para and introduce yourself. We generally reach out to you within 48 hours of receiving the query to have the first discussion, or maybe asking for more details, and then we can start that conversation. The other way is to just write an email. What's the company registration fee? So I think the mandatory fee is not too much. Not able to recall the exact figure, but overall, your company registration, including the CA fees, the statutory dues, your minimum 10,000 paid up capital, it will take something between 25 to 30,000 rupees to complete that process. I have 30 plus years of corporate experience, including global plus domestic, and seek to start up in one of my areas of expertise. Will age be a negative factor? No, age is generally not a negative factor. Your experience can in fact help you. And again, that depends completely on your plans. Age is not a negative factor. In fact, you can have a younger co-founder or people. So that's really not a very important factor. Can a founder be director of two companies and raise funds for only one company? Yes, this is possible. Now, would the investor be interested? Investor will definitely be interested to know what the other company is also doing and how you have structured those things and how much time you're giving to both, because in the end, they are putting their money on you. So they'll try to understand how much effort you're putting in terms of, now I have two companies. In one company, I'm just putting 25% of my effort. In another company, I'm putting 75% of my effort. So if I'm asking money from investor, they'll surely be interested to know that. But yes, it's nothing that stops you to raise funds in one of the companies, but be transparent with the investors about this. Okay, how do company enter the stock exchange market to exchange its shares? All right, so you can go ahead with an IPO. You need to meet certain criteria for an IPO in terms of the revenues, growth, and all that. If you're able to make that criteria, then you can apply for an IPO. There are certain companies that help you get yourself listed. There are specific firms that do that so IIFL probably is one of them. IIFL can help you in terms of going for listing yourself as an IPO. There's also something called an MSME IPO. So in MSME IPO, the criteria is much less. But again, you'll have to meet the minimum criteria before going to enter the stock. Okay. All right. What about the solo promoter versus multiple? So again, as I mentioned, you need to have a private limited company registered with 2 directors. There can be 3 directors also, 4 directors also, but minimum 2. Reduce the chance of funding. Again, if you have a good team that can execute, investors will still show interest, but having a co-founder always helps, because then you can probably divide the major tasks amongst you and the co-founders. Investors are obviously interested to know how the team can deliver, and they're relying on employees is not like a very big factor. But if you have 2 very active co-founders and promoters, and they can complement each other's skills, then it enhances your chances of funding. Details required for VC funding opportunity. Again, this is a very generic question. I'll also need some more details on what you're asking. And I think the last question, Dr. Gaurav can answer better than me.
Kindly solve them, query, sir. I do not have much knowledge, sir, as compared to you.
So
it will be better
there's a
to-
question. There's a question that can I take incubation at Galgotia, and if you have any go, so that you can definitely answer.
Okay, can I take incubation? Yes, for the incubation at Galgotia University, you can apply and you can by the website, visit the Galgoti University website. So there are several funding opportunities available for the private limited companies only. But you can incubate in the pre-incubation stage also. We will provide you mentorship support and sitting area and all the infrastructure you needed to develop your idea to the prototype. The next question, yes, sir. Dinesh. So the next question is, the would an investor be interested even if company is making loss on paper but the good number of customer? Sir, I think you can answer it.
All right.
Yes, sir.
Okay. Would an investor be interested even if the company is making loss on paper but have good number of customers? Yes, if you can justify why the company is making loss on paper. Now, there are two things. One is revenue, and the other is your burn. The burn rate is basically the amount you're spending in the company. And a lot of companies that are raising funds are actually in loss because the amount they're spending is more than the amount they're earning. So it's essentially a loss-making company. Now, your spending could be more in terms of marketing efforts, in terms of validation or doing customer pilots, and you're not getting enough revenue. So if it's justifiable why that loss is happening, if that loss is happening for growth or for customer acquisition or for marketing or to have enough manpower to kind of reach to a profitable stage, then it's fine. Most of the companies that are doing early stage fundraising are in loss only. All right. Any more questions for me?
Any other question? So this was a wonderful session, sir, and I would like to thank all the participants to making this event very interactive and successful. And again, I am very fortunate that Ashutosh sir has accepted our invitation to become the speaker, keynote speaker. Do you have any query? Oh, okay. So,
Hi, Dr. Praveen.
so you have conducted a wonderful session, sir, and you have solved all the query of the participant also. So now I would like to request Mr. Praveen Kapoor, sir. He is the co-founder and once angel investor. He is also on a company, BBoss Technology, and that is a growing entrepreneurial ecosystem, a largest entrepreneurial ecosystem to facilitate our speaker. Kindly over to you, sir.
Thank you, Gaurav sir. Good afternoon, friends, and good afternoon specifically to Dr. Ashutosh. You also, on behalf of Galgotia University, I would like to express my sincere gratitude to Dr. Ashutosh for your valuable insight on topic angel investor and VC funding opportunity for early stage entrepreneurs. We all know Dr. Ashutosh actually that under his mentorship, FIIT IIT Delhi startups are flourishing and achieving remarkable success. Under his guidance has been instrumental in the fostering innovation and growth at IIT Delhi. Sir, your comprehensive insight and practical advice were incredibly enlightening and have undoubtedly provided attendees with the deeper understanding of the subjects. You cover very well. You cover, topics like funding option for startup, under which you share 3 points: equity financials, debt financing, and grants. Later, you also cover how long does it typically to source angel investors. You also share very few, good points on important. Know your audience, know your investors. Right? You even later on you share how to develop a relationship with your investor actually. So I remember, I recall when I was a once I will say I'm not the investor. Once before lockdown I invested into startups, right? And after the lockdown, I was thinking, I lost everything, but somehow I managed to recover my 1.5, right? What I have invested. So, Dr. Asutosh sir, as a token of appreciation, I am pleased to present you the memento on behalf of Galgoti University. Kindly accept this memento.
Yes.
Thank you
Thanks, sir.
for sharing your time and wisdom with us, sir. Thank you so much.
You're welcome. Thanks a lot.
Thank you. Thank you so much, sir.
Thank you. Have a nice day, everybody.
Thank you. Thank you so much, sir. Thank you.